I thought I'd try and step away from the headlines that you're being bombarded with and just bring some perspective. This is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community. In the month of October, the market finished lower, and people are worried about what to do with their portfolios. And what I want to show you is for the last 20 years where we had similar headlines or similar things to be worried about. Every year you have something to be worried about. Let's look at what rates of return looked like. So first and foremost, because inflation's high, what's inflation for the last 20 years? What do you think that is? 2, 4, 5%? Well, as you can see, it was about 2.5. Okay, what about the average return on a home? What do you think the returns there were? 4, 5, 7? Well, the actual 20-year average is about 3.7. How about the return on the government bonds, which interest rates have been low and now they're high again, but the average for the last 20 years is about 2.7. But for the last 20 years with war and with high interest rates, low interest rates, unemployment, uncertainty in Washington, uncertainty in the climate, what was the average return of the stock market for the last 20 years, ending in 2022 after a down year? The average return for this, the S&P 500 was almost 10%, which ironically is almost its 100-year average. So if you have almost a 10% return in equities and you have about a 3-ish% return in government bonds and inflation and your real estate, what do you think the average investor did of these different asset classes? Well, the average investor underperformed the U.S. stock market, with the average investor only doing about 3%. And why is that? It's because they keep reacting to the headlines or to the short-term concerns that arise when history shows as a humanity, we work through our problems, we end up being better for them, and we continue to try and make our lives better. So if you're retired and you're living off of some of these portfolios, like we've said before, first and foremost, let's not overreact to headlines that are valid concerns. But again, unless you need all your money today or in the next year, this is something that we want to ride out and not overreact to, because we don't know what's going to be the catalyst that turns it, and history shows are often the catalysts that turn these markets around. Again, we want to pay attention to our cash reserves and what we need as we plan out 2024, so let's be having that conversation. For our clients that are accumulating, again, take advantage of the monthly income that you can set aside and dollar cost average into these markets. And again, for most people that are out there that aren't our clients, especially if you have been overexposed to the bond market for the last 2 or 3 years and got hurt with interest rates rising, or you're not having the conversation about what kind of reserves you should be having aside, or worse, your advisor's calling you and panicking about what you should do with your portfolio and why you should move some things around, that's often how you end up underperforming the very investments that you could have owned for the last 20 years. So come have a conversation with us. And so don't lose sight of the short term. Just because the leaves are changing doesn't mean you need to abandon the trees or your long-term portfolio, and try not to overreact to the next couple months of volatility. The purpose of these up or down videos is to try and bring a little understanding about what you should be doing with your long-term investments based on what is going on. And so this is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community.